For this week's Smith Business Close-Up, we are on location at the University of Maryland at the Robert H. Smith School of Business. And joining us is Pete Kyle, who is the Charles E. Smith Chair, Professor of Finance. Thank you for being with us.
Well, thank you for inviting me.
We wanted to focus on all this controversy about high-frequency trading. The Michael Lewis book has gotten a lot of attention. What are we talking about with high-frequency trading?
Well, high-frequency trading can be defined as trading where being faster than everyone else is important for being able to make money.
And that's, historically in trading, speed is an advantage.
Historically in trading, speed is an advantage. The invention of the telegraph, the Pony Express, even ships, all of those technologies were high-frequency trading or high-speed trading in their era.
So it's all relative.
It's all relative. The paper tape that they had in 1929, that was high-frequency trading back in those days.
So Michael Lewis is a well-known author. He goes on 60 Minutes and says that the market is rigged. You've looked at his book. Do you share that concern?
Well, I don't think the market is rigged in the sense that the overall level of prices in the market is wrong or off because of high-frequency trading. What I think he means is that there's a troll under the bridge, and the troll under the bridge charges you something extra when you want to cross the bridge. It's probably about a penny a share, in my opinion. Less than it used to be in the past, but it's somebody put the troll under the bridge and allows the troll to stay under the bridge, and that's the sense in which the market is rigged. The trolls, of course, the high-frequency traders.
Who are the trolls taking advantage of? They're
taking advantage of everyone who wants to trade. But if you look at the structure of the stock market, it's dominated by large institutional investors. The very small investors like you or me trading 100 shares, we probably give up our penny. So it's costing us a dollar a trade. To the high-frequency traders, it's not very much. But if you're talking about a gigantic trader who wants to trade 1 million shares, then it starts adding up to a lot of money.
Is your view that there's a regulatory solution? Can market structure be adjusted? Can the SEC do something? Or will the high-frequency traders just find a workaround?
I think you can do something. The SEC did something a number of years ago with a regulation called Regulation NMS. And that regulation, which took effect in 2007 but was drafted before that, was drafted at a time when like a second or 10 seconds or 30 seconds was considered to be a lot of time. And since then, the speeds with which things happen have just increased exponentially, so that now we're talking about microseconds, not even milliseconds, instead of seconds. I think Regulation NMS needs to be revisited, and it could be altered in some fairly simple and straightforward ways that would make the playing field level and get the troll out from under the bridge.
How out of balance, if the playing field's not level today, how far off is it?
I guess
what I'm getting at is how concerned should the public be in addition to the regulatory authorities?
Well, I don't think that the public should be as concerned as they probably are. The market actually functions pretty well, but I do think that the public would benefit from having the market function even better. And the simplistic things that could be done would be to centralize the order flow more so that you don't have 13 or different exchanges and lots of different dark pools, but instead have all orders crossed at one exchange where time and price priority is respected. And the second thing that can be done is just to change the technology a little bit so that people that have very, very low latency don't get a huge advantage over people who are very, very slightly slower.
Dark pools could be a whole other topic for discussion, but what do you mean by that?
Well, I think of a dark pool think of it as a private club where only certain people can go and transact business with each other, and they do it out of the sight of everybody else in the market. After they've done it, they have to report a trade publicly, but the problem as I see it is that in reporting that trade, they're actually using the prices that the market has established to help them price the trade, but they're not giving the market a chance to participate in that trade. That's why it's called dark, and it's also private.
Very good. Professor Pete Kyle, thank you for being with us.
Okay, thank you for inviting me.